Hello and welcome back. Thank you for joining me. Last week I reviewed EPR Properties and I had some comments asking that I review some other REITs. One was IVR, which is Invesco Mortgage Capital, which is a mortgage REIT, and somebody else asked if I could review ABR, which is ARBBOR Realty Trust. And so I've decided for today's video, I'm going to actually review both of those and we'll compare one alongside the other and literally see how they compare on comparable metrics. And then at the end, we'll have a little score and we can see which one was best. Simple as that, really. If you're new to this channel, welcome. My name's Andy, and on this channel, I like to talk about money and success. If you're interested in either of those two topics, please do remember to hit that subscribe button down below. Give me a thumbs up and help me out on that Google algorithm. Even help me out on the YouTube algorithm. How's that? And I'd be very grateful. So thanks for that. Before we get started, I do need to do the little disclaimer thing. I am not a financial advisor. This is not a financial advice. You need to make your own decision on whether you should or should not invest in any shares I talk about in any of my videos. If you're unsure what a REIT is, then I will put a link in the description down below to a previous video I've made, which is literally called What is a REIT? And it will explain what it is, but it stands for Real Estate Investment Trust. And if you would like me to do a review of any particular share or a comparison of two shares, please feel free to put a comment in the description down below, letting me know what you would like comparing, and I'll be happy to do so. With all that said, let's dive right in. Now, both Invesco Mortgage Capital and ARBOR Realty Trust are mortgage REITs, or mREITs, as they might be called. Now, what they do, the way that a mortgage REIT or an mREIT makes its money is it borrows money at one rate and it lends it out at another rate. And the difference is its profit, okay? So that's the concept of how they make money, unlike a regular REIT, which would own a property and receive rents from the property. mREITs or mortgage REITs, which is what both of these are, don't actually own the properties, okay? So it's purely a financing thing. So I'm going to take you through exactly what lending each one does first, so you can see what it is they're doing, and we're going to assess the risk of that. That's going to be factor number one, and then we're going to go through a whole host of other factors. So let's start off with Invesco Mortgage Capital, Inc., which is a real estate investment trust or REIT that invests in, finances and manages residential and commercial mortgage-backed securities and mortgage loans. They've put that their objective is to provide attractive risk-adjusted returns to our investors, primarily through dividends and secondarily through capital appreciation. We completed our initial public offering in July 2009, and that is them. Let's have a little look at their investment strategy. So their portfolio strategy, this is the sectors they've broken up to. So they have agency residential mortgage-backed securities, or RMBS, which you see on the pie chart, takes up 44%. Agency commercial mortgage-backed securities, or CMBS, which, as you can see on the pie chart, takes up 16%. Non-agency RMBS, which is a residential side, non-agency CMBS, which is a commercial side, and credit risk securities issued by government-sponsored enterprises. Other real estate related financing agreements. Now let's have a little look how that compares to ABR. So ABR, or ARBOR Realty Trust. ARBOR Realty Trust, Inc., New York ticker symbol ABR, is a nationwide real estate investment trust direct lender providing loan origination and servicing for multifamily, senior housing, healthcare, and other commercial real estate assets, headquartered in New York, basically. Now, the key line to look at here is it says specializing in Fannie Mae, Freddie Mae, and other government-sponsored enterprises. Now, they're nice and safe and secure, okay? That's an important factor to remember. So let's have a little look at their portfolio. There's their portfolio breakdown. And what I really want you to look at is the pie chart on the right-hand side, where you can see that 74% is Fannie Mae, FNMA, and 23% is Freddie Mae. Now then, I'm going to just tell you a little bit about Fannie Mae and Freddie Mae so you can see why that's so important. So Fannie Mae and Freddie Mac even. Fannie Mae and Freddie Mac are home mortgage companies created by the US Congress. Neither institution originates or services mortgages. Instead, they buy and guarantee mortgages through the secondary mortgage market. So it's a method of guaranteeing the loans, okay? And they are seen as too big to fail. So the US government won't allow Fannie Mae or Freddie Mac to fail, okay? I always thought they were nice old folks, Fannie Mae and Freddie Mac, but apparently turns out they're not. They're actually quite good if you've got a loan. Just copied that straight from Wikipedia. I'll leave that on there. You can read that at your leisure, but that tells you a little bit about Fannie Mae. The next slide here tells you a little bit about Freddie Mac. Again, I won't read it, but they're both very big, too big to fail. And basically they guarantee mortgages and loans. Okay, so that's basically what they do in a nutshell, which is why I have given the first round to ABR, because ABR, its loans are essentially government backed, the majority of them, as you could see. And if that's the case, I would say they're going to be a lot safer than what IVR are lending out on. So that's round one. Let's carry on. As you can see, ABR's share price peaked at $15.77 and is now sitting at $8.86, which makes it 43.8% down from its 52-week high. It's got a dividend yield of 13.54%, which is attractive if I do say so myself, and it's got a current PE ratio of 40.56, which is extraordinarily high. If you don't know PE ratios, you generally want lower than 20, so that's high. So let's have a look now how that compares to IVR. So IVR has a current share price of $3.50 versus a 52-week high of $18.30. Its dividend yield is 43.43%, which is obscenely high. I would say that's at risk of being cut. I would not expect that to hold out. And its PE ratio is 9.74, which is low. That's nice, that's attractive. So for our next round, as you can see, PE ratio we're going to give to IVR because IVR has a more attractive PE ratio. Dividend yield, I'm actually giving that to ABR, even though IVR's was higher, simply because I think it's going to get cut. It's too high. 43% is not real. That's just not going to happen. No dividend. If you found me a dividend that consistently pays 43% dividend yield, I need you to put a comment down below and you let me know, because I need to buy that dividend because I ain't found it yet. So yeah, 43%, that's the red flag. 13% is high, but so you know, with mortgage REITs, it's actually not uncommon when I've been researching this. I've actually found that they tend to be between 7 and 15%. So a 13% within that range. So I think more likely, I'm not saying it won't get cut, but it's less likely to get cut, which is why I've given it that point there. And as for the share price, I'm actually giving that one to IVR because it's down so much lower compared to where it's been in the past. There's that much further room for growth. It's down 80%, the other one's down 43%. So that's why I'm giving that point to IVR. Although you could read that the other way and say it's in worse shape, but I'm not. I'm assuming it's got the room to grow. Let's give it some benefit of doubt there. Okay, so next let's look at the income statement. So on the income statement, what I want to look at here is the net interest income, and as you can see, it's mostly been going up. Since 2016, the net interest income has been rising year on year for ARBBOR Realty Trust. And if we look down at the bottom there, the total revenues, yet again, they are increasing year on year, with the exception, as you can see, 12 months to date, it has fallen a little bit, but then you'd expect that everything's having a bit of a rough year right now. So let's have a look how that is comparing to Invesco Mortgage Capital, or IVR. So Invesco, not good, is it? So net interest from income, it's actually made a loss in 2019 and it's on course to make a loss as well this year, so that's not good. It was, until that point, I would say, doing okay on the net interest income. It was increasing. On the total revenues, wow, that's all over the place, up and down and up and down. And look at the losses it's having in the 12-month year to date, the TTM. I would say that's very bad. So I'm going to give that one, without any shadow of a doubt, that one's going to ABR. So ABR gets the point because the income statement is very bad, as you can see on my notes there for IVR. We're not happy with that. Let's now have a little look at dividend safety. The key things I want to look at on here is the revenue per share and the dividend per share. As we can see here with IBR, back in 2015, it had a revenue of share of 174 and a dividend per share of 60 cents. That's fine, that's affordable. 2016, 334 to 64, great. 2017, again, 471 to 76, fine. 2018, 533 revenue to 104, perfect. 2014, 433 to 117, again, great. And the year to date so far, 317 to 119. So that's looking good to me. Let's have a look at IVR. On IVR, oh dear. Well, I can see straight away we've got negatives on here. So as you can see, you've got negatives. So there's not even any point in looking at the year to date. Just look at the current year. You've got a loss per share of $9.48, and yet they're planning on apparently a dividend per share of $1.85. Obviously, that's not really going to happen, is it? So we're going to give that round to ABR, as IVR almost certainly going to cut the dividend. Right, next we're going to look at the balance sheets. So this is the balance sheet for ABR. Now the key things to look at on here, or that I'm looking at, because we're just doing a quick overview, remember, I'm going to look quickly at the total assets. So this is, which one is this? This is ABR. So the total assets, they're generally increasing year on year. I'm happy with that. That's great. And the total liabilities, in fairness, they're generally increasing as well, but pretty much in line with. So I would be happy with that. That's absolutely fine. I will take the total assets and divide it by the total liabilities in a moment, just to see what the ratio is, but I'll do that in a slide in a moment for you. Let's have a look how IVR looks on the balance sheet. So IVR, their balance sheet, total assets falling, up, no, down, up, down, up, down. They're all over the shop, aren't they? And their total liabilities, in fairness, the total liabilities are going up and down at the same times as their assets are going up and down. So I'd say proportionately they're staying the same. So that I would say is actually a draw. Let's have a look how it works out. Asset versus liabilities, the ratio there, 1.17 for IVR and 1.21 for Arbor. That's much of a muchness, quite honestly. We're looking for that number to be over 1, for them to be solvent. Essentially, it's over 1, so I'm happy with that. That's okay. So I'm going to give them a draw on that. And there you go. They've got a draw for assets versus liabilities, and they've got a draw on the balance sheet. Although I did slightly prefer ABR's balance sheet, I'm giving them a draw on that one. So now let's check out the dividends. So ABR, as you can see, payout ratio is astronomical. The dividend is 13.54%. But the important things to look at on here, I think for this one, we're going to look at for this comparison, is the 5-year growth rate. It's 17.34%, and it's been growing for the last 8 years, which is obviously good. And if we look at the dividend history, that's the chart. If we look at all time, you can see something went wrong in 2019, but since then it's generally been increasing, up and up and up, at a drop there. But over the course of that year, it was still higher than the previous year. So 2019 was still higher than 2018, despite that one dividend down there. So that is ABR. Let's have a look now at Invesco's scorecard. So it's got that 43.43% yield, which is ridiculously high. Again, a ridiculously high payout ratio. No years of dividend growth, and it's actually been falling over the past 5 years. Let's look what the history looks like. Yeah, it's pretty flat. It's falling, staying the same. There we go. They dropped the dividend, like we said. So the dividend's been dropped there to just 2 cents from 50 cents. So that tells you everything you need to know right there. It's not happy. Now, it might come back, and if the dividend comes back, no doubt everything will be great. But right now, financially, it's not looking very rosy. So now let's see the summary, how we're doing. So we're going to give dividend growth to ABR. We're going to give dividend, how many, growing in the years, if you like, to ABR, because it's grown for 8 consecutive years. Although that doesn't mean that it's going to continue. Just to be clear, we can't guarantee it will continue growing. Its payout ratio is obscene. I'm not saying it's a super healthy business, but it's healthier than IVR for sure. Let's have a look here. This is the analysts' forecast. So the analysts are forecasting that ABR's price in a year's time will be between $10 and $11.50. So they've got that on a moderate buy. There's only 2 analysts have actually reviewed this, but the analysts that have reviewed it, they're saying that it's going to go up over the next 12 months. So that is the Analyst forecast for the share price of ABR or Arbor Realty Trust. And for Invesco Mortgage Capital, the analysts are forecasting it to go down. It's currently $3.50 and they are predicting in the next 12 months it will drop to $2.50, and that's 5 analysts have done that. One analyst is predicting a hold and the highest was $3. So that's pretty conclusive. They don't like that. They think that's going to go down. So we're going to give analyst forecast to ABR, and there that gives us your final score. It's IVR 4, ABR 9. We have a clear winner. Now, I'll be honest with you, neither of them have convinced me that I'm wanting to invest in either of those two shares. I usually would be saying at this point, yeah, this is the one I want. Not really, if I'm honest with you. None of this looked particularly exciting to me. I can't guarantee that dividend yield is going to hold up on either of them. If you want to buy them as a speculative play, that's entirely up to you. So when I finished editing, and literally I'd finished the entire video and I thought I'd finished, I went to bed, thought about it more, and I thought, actually, there's more I want to say about this. So here we are. I want to just explain a couple of things. So the way I see it, valuing these companies is quite a difficult one to value, because really it's down to the people they lend to and the quality of the borrowers. Are they creditworthy? Are they going to repay? Because if they're not going to repay, if they start defaulting, that obviously is going to hurt the business, and the business isn't going to be able to pay out its dividends, which, you know, at the end of the day, they are mortgage REITs, so their purpose is they are dividend stocks, so certainly not growth stocks. And I'll look at the value with you in a moment, but they're certainly not growth stocks, they're dividend stocks. And if they're not getting the money in, they're not going to make the money to be able to pay the money out, because their margins will get squeezed. Furthermore, if their credit rating of the actual REITs themselves, either of these companies, goes down, it may be that they have to borrow at a higher rate. So while interest rates are low, if they're borrowing at a higher rate than they ordinarily would and lending at a lower rate than the ordinary, their margin, their bit in the middle, is reduced. And if that's reduced, their profit's reduced. If their profit's reduced, what they can pay out is reduced. And that obviously therefore reduces the dividend, which in turn, I believe, would depress the share price. With that said, let's have a little look at the share prices, just so you can see. ABR, as you see, Arbor Realty Trust, its share price was really high back right up until about 2007. It went up to like $32 up there, it peaked out, look. Then it plummeted in 2008 and stayed down, and it gradually recovered. But I mean, it went all the way down to like 64 cents. It's currently $8.86. So, you know, more than 10 times, 12 times that amount at the moment. It's gone up, but not a great deal. And if you look around there, that's less than the current price. So back in 2016, 2017, it was actually cheaper than it is now. So if you think you're getting it cheap, not relative to then, you're only getting it cheap relative to 2019. If you think it's going to go back to 2019 levels, then sure, it becomes a buy. But if you think it's going to do what it did before and just stay low, then it's not such a good buy. So let's have a look at IVR. IVR, it started up at the $20, it dropped down 14, it went back up to 20, back down, and then down more, up a little bit, but it never really got past $17, $18 there. And by 2019, it was at $18 before falling off a cliff. Now, if you think it's going to go back to that level, then it actually, price-wise, it's a very attractive buy. And that's why I gave it that point for the value in comparison to its usual share price earlier. If I didn't make that clear, hopefully this does make it very clear. But that's the reason for that. But of course, there's no guarantee that it'll go back to that price. Personally, I really don't know what's going to happen with it, because I don't know how interest rates is. Too many variables that I'm not able to factor in, which is why, I hate to say it, but I'm actually sitting on the fence, and it's why I'm not going to invest in this. I'm certainly not putting any money into these stocks myself. Whether you do or not is, of course, entirely up to you. That's your decision to make. If you feel you understand it better and you feel that they will go back up, then fine. That's your call to make. But me personally, this isn't one for me. But I hope you've enjoyed this. I hope you found this useful. If you'd like me to review any of the stocks or shares, particularly dividend stocks, please do give me a comment down below and let me know which stocks you'd like me to review, and I'd be very happy to do so, particularly dividend ones. Other than that, thanks for watching, and bye-bye.